So welcome everyone, and thank you for making time to be with us. I'm on a train, so that's why I'm using my phone as a microphone. So it's not a weird thing, but I'm hoping that you can hear me properly and clearly. We're super excited about the session today, and I do want to just apologize on behalf of Natasha, who was supposed to be our original uh, speaker, who unfortunately for some unforeseen circumstances can't join us today. She's not feeling well, and hence her colleague and boss Bjoern has joined us. Bjoern was really excited that you could step in at the very last minute to speak to us on this very exciting topic. Um, you'll see Bjorn's bio on the screen at the moment. So if you look at your screens, Bjorn's bio is up. He comes with extremely high credentials and experience. So on one hand, it's a real pleasure for us to have Bjorn join us today. And we look forward to a really exciting conversation with Bjorn. Please have your cell phone ready because we'll need you to use your cell phones to help us get some responses to a couple of questions. But thank you so much for making time to join us. And once again, if you're joining us, please, your name, your organization, and where you're dialing in from. Got a really good spread of people from across the continent. So I urge you to please take out your cell phones and use it to access the QR code on the screen. And for your information, this webinar is being recorded, just for everyone's information, it's being recorded. So if you don't mind answering the first question, we'll give it about 30 seconds. We'll encourage as many of you as possible to participate in the poll. Just use your cell phones, get to the QR code, and you should get access to the questions. Well done. We've got about 25 people who responded. Like us to get as many responses as we can. Alternatively, you can go to slido.com and use the hashtag number shown on the screen to respond to the same survey. Another 10 seconds. Awesome. It looks like we are a good batch of creative. Remember, this is the second have
Frank, we can't hear you.
All right. Sorry about that. Frank is on transit on the SGR, the train in Kenya. So maybe he got to under a tunnel or something. Let's give him a couple of minutes to see if he can connect back. If not,
can you hear me now?
Correct. Yes, we can.
Okay. So thank you for that. Well, Abby, can you run the next one? So this is the second poll. How much do you know about impact linked finance? take another 30 seconds to respond to this. Another 12 seconds. Let's have as many of us responding as we can. Okay, cool. So a vast majority of us are here to learn, which is great. This is really good. This is a really exciting space for many of us. I think we'll all be learning a lot through this process. And then, Abby, let's run the third question before we welcome Bjoern. Which of the following does your organization best identify with? Let's get a sense of who are in the room. 30 seconds. If by any chance you've typed other, do you mind typing in the chat what other represents? Because I can see where a good chunk of us was who clicked on other. You mind just putting in the chat what other represents? So high representation of people in the consultancy services, philanthropy, a couple of fund managers, a couple of corporate players. And if you've typed other, do you mind telling us in the chat what other means or what your organization does? Okay, so we've got a good sense of who's in the room. So without further ado, I do want to welcome Bjoern. Bjoern, we're really glad you could make it. So over to you. Abby, we can just stop the poll, and then Bjoern, super excited to have you here. Will please take over.
Yeah, thanks a lot, Frank, for inviting me, for having me here. I'm stepping in today for Natasha. My wonderful colleague is sick, and I'm covering the content today. So I'm going to talk about impact-linked finance as a type of catalytic capital, I would say, and I'm going to talk about this later. Probably one of the most effective types of catalytic capital. A little bit of introduction of myself. I'm actually an ex-banker. I spent 20 plus years in the mainstream banking industry before I joined the impact sector in 2012. So after a 2.5-year sabbatical, where I worked actually intensely with entrepreneurs in helping them to raise investment, preparing for investment, in particular impact investment. I learned a lot from these people and their needs on the ground. I founded Roots of Impact in 2015. As starting as actually as a consulting firm focusing on impact investors, be it foundations, be it family offices, or even corporates. But over time, shifting towards specializing on managing catalytic capital, and in particular, impact-linked funds, deploying impact-linked finance. And I'm here today actually to share with you what this means, what this is, and how this relates to the topic we are discussing today, catalytic capital. So let me quickly share my screen, and then we can dive in. I hope you all see my screen. So catalytic capital, the role of impact-linked finance. So let's quickly go back to, I know that you had last month a webinar with William from the Rockefeller Foundation, and he described, of course, what it actually means to work with catalytic capital. Just as a quick reminder, catalytic capital aims to create impact by correcting for underlying capital gaps. You could also say by fixing market failures, because we all know that when the conditions are attractive, capital flows, and when conditions are less attractive, from a pure financial perspective, capital does not flow. And catalytic capital is in so far unique that focuses much more on impact than on financial returns. And going one step further, there's a very nice definition of catalytic capital by Tideline. So by definition, catalytic capital does accept disproportional risk or concessional terms, which actually means from a pure financial perspective, it's less attractive to pure market-oriented investors. However, this is necessary often to create effects, in particular to generate positive impact and at the same time enable third-party investment. And it's very much also about additionality. So donors call it additionality when with a certain intervention or a certain type of capital, for example, things happen that otherwise would not. And catalytic capital is exactly this. It flows where traditional capital does not flow, and it closes the gaps that are left behind by pure commercial capital. As a manager of catalytic capital, it's of course a big question. What kind of tools are most appropriate to use? You might think of very early stage enterprises that need seed capital, where you need just to accept high levels of risks to get them going, so that they can prove their model. But there are also many different types of capital, in particular, if you are able to deploy it in a flexible way and tailor it to the needs on the ground. So think of guarantees that could be provided to sweeten a deal, to de-risk a transaction, and I will talk a lot about incentives here. So what is impact-linked finance and how does it relate to catalytic capital? Let me quickly start also a bit how I came personally to this practice. So when I was active in impact investment, I realized, okay, putting money on impactful ideas is absolutely necessary and is needed, but there is a big flaw from my perspective, because even in impact investing, a practice that is clearly intentional to create impact on the ground, there are no incentives in place to actually optimize for impact, neither for the entrepreneurs nor for the investors. So there's no hard wire of impact performance to impact investment. So typically an impact investor looks at opportunities from a financial and from an impact perspective. But if impact is kind of proven or expectable, then the rest of the conversation is very much about finance. And I found it as I said, I came from banking. And 10 years ago, when I entered the field, I was wondering how serious impact investing is about the so-called double bottom line. And for me, it's clear that the second part of the double bottom line is not appropriately covered in the practice. And you can also think about this like that from a perspective of an enterprise active in the field, there are two kinds of, coming back to the double bottom line, two kinds of value these enterprises create: the financial value and the social value or impact. And in many cases, enterprises act in areas, in segments, and topics where the social value is exceeding the financial value, where they actually serve a target group that is commercially not as attractive as in other fields. And you can call these enterprises however you like. There are so many different terms: impact enterprise, social enterprise, or just an enterprise acting and working in a very difficult environment. All these enterprises have an issue because this gap, this value gap, is not monetized. They're not able actually to capture this value entirely in their business model. If they could, they would be on ice level with commercial counterparts. And for that reason, at Roots of Impact, we started actually back in 2016 answering the question, what if we could price this value and reward positive impact? You know this principle already, that's nothing new. You know it from carbon finance. However, carbon finance is a very focused and specific field and very specific impact. And we translated this idea of monetizing positive impact to social outcomes. And I show you how this actually works. So the basic idea behind all this is better terms for better impact. And of course, this has thinking about better terms for better impact from a systems perspective. This has multiple reinforcing effects. Think of a system where the more social return, the more social value a business creates, the lower the financing costs get, which creates actually a positive cycle of continuously trying to optimize for impact and getting better on impact performance. That's of course not reality. However, we can create tools and instruments where this happens actually on a deal-by-deal basis. In practice, this looks like that. So think of DFI, development finance institutions like the DFC. So we are right now partnering with DFC on so-called gender impact-linked loans. And in these loans, DFC is providing capital to high impact enterprises that have the potential actually to improve their impact, their gender related impact. This can have several forms. I won't go into the details. It's just really about the basic principle of incentivizing a company that does probably already good to do even better, and for a very specific target group, and engage in women empowerment. And the better the enterprise performs on predefined impact metrics, the lower the cost of the loan. So the interest rate goes down according to achievement of social outcomes. That's the whole idea of an impact-linked loan. And this works in practice quite easily. So it's not a very complicated thing. The only challenge, of course, is about measurement of these outcomes. And this has to be done properly. Here you see how an impact-linked loan can also be used as a blended finance structure, because there are not so many investors in the market who would be willing to sacrifice on their returns, right? And forgive returns. So for example, if you would agree on an interest rate step down of up to, let's say, 4%, in exchange for a better impact performance, then you have 4% less income as an investor. And for that reason, and everybody has a role to play in this ecosystem, right? There are outcome payers in the market. These are typically donor organizations like development agencies or philanthropy foundations that can actually compensate these investors for every kind of discounts they would provide. So the investors do not benefit from that. It's just a compensation, an offsetting of the discounts they provide to the enterprise. And then it becomes actually a blended finance model. And coming back to our topic of catalytic capital, of course, this agreement between the outcome payer and the investor is highly catalytic to actually increase the impact of the enterprise and attract investment. Here is a model which is even easier because it very much is comparable with carbon credits. And it was actually the very first instrument we implemented back in 2016 and piloted the first time, called social impact incentives. So as social impact incentive, or in short, SINC, it's a simple contract, a bilateral contract between an outcome payer, again, probably a development agency like USAID or agencies like that, public agencies, foundations, etc., committing to pay impact enterprises for social outcomes. It's a premium payment because they are not entirely financing the enterprise. They are just paying a top up to their income for additional outcomes the enterprise would create. Typically a contract over 3 to 4 years with a clear commitment, we are paying you every 6 months according to the incentive scheme. And then there is a condition in a contract that the enterprise has to raise investment, because a SINC is structured in a way that it should enable an impact enterprise to scale, and on the way to scale, to significantly increase its impact. So the contract of the outcome payer actually has a closing condition that the enterprise needs to raise investment, and it, of course, also enables the enterprise to raise investment because every payment is a revenue for the enterprise and makes it simply more attractive to investors. Here's a quick example of a fund we are managing, the Impact-Linked Fund for Gender Inclusive FinTech. And it's also an example that you can use incentives in very, very different ways. In this specific fund, which is actually also covering FinTech companies in Africa, we are partnering with existing fund managers who are already providing investment to early stage FinTechs. However, this is typically a VC approach, very growth driven, very strongly focusing on scaling these companies and also having an early exit. And as you might imagine, this is not a model that is clearly calling for inclusiveness. However, we know that FinTech, at least in theory, have a significant potential to serve the underserved and to go where traditional finance would probably not go, and to lower the costs for doing so, and also to reach women and provide opportunities, actually economic opportunities for women. And for that reason, we are providing actually incentives to the FinTechs these fund managers do invest in. And we are explicitly agreeing with them that they would improve their gender-related performance. Normally, FinTechs grow in a way that is rather, let's call it gender neutral or gender agnostic. And we put a clear price tag on the impact they could achieve by focusing much more on women. And by the way, this is not necessarily trade-off. As we all know, women are fantastic customers, and it's just an overlooked opportunity, and we can reinforce this with incentives. So what does the incentive actually result in? Here you see two effects of rewards we are providing. On the left side, it has a positive effect on the profitability of these companies because it's simply increasing the total revenues. And on the right side, and that's as important as the left, it creates additional impact beyond what would have happened anyway. So we are actually, the outcomes funders are actually buying impact of existing businesses in the market because they can deliver the impact probably much more efficiently than other players. And in order to position impact-linked finance also compared to all the other practices, you know, and you might be confused also about, here is a quick explanation how this is different. It differs from impact investing, as I already mentioned, because it's actually, the impact is hardwired here. So impact investing seeks positive impact, but it does not have any incentives incorporated to achieve it. Impact bonds, which are actually also outcomes-based contracts, and we were, of course, inspired by impact bonds, are also a very different instrument because impact bonds typically focus on non-profit interventions and have to fully finance the intervention, while impact-linked finance instruments do provide top-up payments or premium payments to businesses to improve performance in terms of impact, which is a very different logic. And it's a direct contract between an enterprise and a payer, while impact bonds are a multi-stakeholder agreement and quite complicated actually to set up. Performance-based contracts are actually very similar to sync. So a contract where a funder agrees to pay for performance. However, our sync model is built in a way that it is always combined with investment, and it should be considered a blended finance, a catalytic part of a blended finance transaction. And last but not least, as I already said, it's quite comparable with carbon credits. However, you could consider sync to be the carbon credit for the rest of the 17 SDGs. Quick example of a past transaction, and I will also show you some facts, figures about the past in terms of regional coverage and number of transactions, etc. Here you have an example of Root Capital, a bit an exceptional example because Root Capital is a lender to agricultural SMEs active in Africa and Latin America. And typically we provide our incentives, be it impact-linked loans or other impact-linked finance instruments, sync. Typically we target these to enterprises and not to investors. Here we have a kind of an exception. We see Root Capital as a lender that also faces serious issues and needs incentives actually to create additional impact. In particular, because Root Capital wants to provide loans also to very small scale businesses that have the potential actually to grow. But the economics of these small loans are simply too bad that Root Capital could actually deliver this on scale. So what we did with them, we actually provided incentives so that they're able to actually provide the so-called high additionality loans below 500,000 US dollar. And also we provided bonuses if these businesses were gender inclusive. And it was quite a successful transaction because we could prove that over time, these businesses were growing and over time didn't need any further subsidies anymore and could just get money from other lenders when they had a certain size and also delivered the impact that was expected. Coming back to the definition at the beginning, so how far does impact-linked finance deliver on these characteristics? Just to compare, impact-linked finance uses philanthropic or grant capital, so clearly accepting high risk and low return, I would say, in order to generate positive impact and by embedding or enabling third-party investment. So it meets the definition. It's actually a subset of catalytic capital. And it is, as I formerly said, I think it's a very powerful form because it comes with clear accountability for the impact you want to see. If you go into the seat of a philanthropic or public funder, why do they typically provide subsidies or below market funding? Because they expect impact, right? And impact-linked finance is just a form of this, where the impact gets really very, very concrete. And the deal is made really on clear results. A quick hint because all this is very strongly focusing on actually the demand side of catalytic capital, which is the enterprise. So we were really thinking of, whenever we develop new tools, what do the enterprises actually need to unlock their impact potential? And we recently did a study, also with support from the C3 consortium, and digging into the perspective of entrepreneurs when it comes to catalytic capital, asking the question, what's in it for the entrepreneur? And how do entrepreneurs see the role of catalytic capital? And we came to very interesting insights. For example, it's not just about low cost, it's also about a strategic lens this catalytic capital can actually take. Very quickly on how this field developed over time and what we learned on the way. Here you see some statistics on transactions on the left side. So this is just transactions where Roots of Impact was involved. I think we were kind of pioneering this practice back in 16 and 17, there was the first closing. Nowadays, of course, there are many others active in this field, but so these are just our numbers. It took actually off in 21 because then there was, after quite some time of experimentation and piloting, then there was clear evidence that this seems to work. And then, of course, we could also attract further partners to engage in this practice. So 44 deals closed until end of 22, and a big pipeline of deals for the future. Very interesting on the right side, what is actually incentivized? And not necessarily only incentivized, what is the focus of these transactions? For example, if you look at the top one, gender. I think impact-linked finance is perfectly suited to encourage and enable a business to stronger focus on the gender opportunity without facing necessarily trade-offs. So you can either clearly structure incentives around this, or you can even focus on businesses that are either exclusively serving women, women-led, etc. So there are so many different dimensions of the gender impact. And here you can see the sectors where impact-linked finance was mostly deployed: agriculture, health, energy, financial inclusion, etc. This will change over time. For example, our impact-linked fund for gender inclusive fintech alone, there are 25 transactions we want to close within the next 3-4 years. So this is just to say that the discipline, the practice itself, is rather sector agnostic. Here you see the regional distribution of these 44 transactions. It's more accidentally how this developed, to be honest. So it's not, it doesn't say where's the potential. And you, of course, will ask me why so little in Africa. We are now heavily focusing on Africa. However, we started in Latin America. So Latin America was the pilot region. And over years, we deployed and had funding for Latin America. Nowadays, we are working across the globe in transactions and funds. And this picture will change over time, probably quite significantly. A few partners that are involved, of course, very strongly dominated by public institutions, DFIs as well as development agencies, but also impact investors partnering with us because we are actually very interested in their deal flow. For example, for the fintech fund, we are partnering with Women's World Banking, Bamboo Capital Partners, and Axion. These fund managers are investing in fintechs and are very interested in gender impact, and our incentives can help them actually to sharpen this. Just 2-3 slides, and then we have a discussion. I would like to come back to definitions and roles of catalytic capital and how far impact-linked finance meets these characteristics. So there are 3 functions, 3 roles catalytic capital can have: a seeding role at the beginning of the journey, a scaling role, helping enterprise to realize economies of scale and stay on track in terms of impact, and a sustaining role where a company probably would need long-term subsidy to really protect its mission and stay on track. And we looked at our 44 transactions of the past and matched them with this, with the 3 stages. You won't see a sustaining category for us because our impact-linked finance transactions are not meant to be subsidizing a business forever. So it's really about unlocking a potential that over time would be fully commercially viable. Yeah? And for that reason, most of our transactions were in this category of seeding. So tailored to early stage enterprises who want to focus on impact while they raise either their first or second round. Or, and we have specific, let's say, instruments also helping these enterprises to build up their impact measurement systems, because that's needed for impact-linked finance. And when it comes to scaling, we did 10 transactions so far. And I added this arrow because there's a strong trend that impact-linked finance gets used in this phase. And the fintech example is the best example. These companies do not struggle to raise investment. They would probably rather struggle to deepen their impact while scaling. And for that reason, there will be much more opportunities to deploy impact-linked finance in the scaling phase and actually use the running machine to increase and accelerate the impact of these companies. So last slide, what we have learned. So it was a bumpy ride since 2016, since the first implementation in Mexico. Now we know what is really critical. For example, just to pick one very critical learning, never try to push a business towards something that is not aligned with their strategy. So this is in particular our job to convince our funders that even if they have very specific priorities, it needs to be a match with the business. What is the strategic orientation of the business? What do they want to do anyway, but are probably not able yet to do? And where they want to create their impact? And where's the opportunity? Where's the overlap between donor interest and business interest? There we go, and there we reinforce these structures to help these companies to actually unleash their potential. And maybe also very important is, because I said we are not going to subsidize a business forever. So when we actually select the companies, we already look at the exit. So our exit, what happens after 3 to 4 years, is then the potential developed so far that a commercial model is possible to drive this further. That's part of the selection criteria, and also we of course consider this when we are structuring our incentive schemes. Oh, there's still another slide. Just to give you an idea which of our funds are active in Africa. So we have a so-called impact-linked finance fund, which is a Dutch foundation where we run our funds. And there we run 3 different funds, but all 3 targeting companies in Africa: the impact-linked fund for education, focusing on West Africa and the MENA region; impact-linked fund for gender inclusive fintech. As I said, this is actually a global fund, whole global South except Latin America; and the impact-linked fund for Eastern and Southern Africa, which is self-explaining and sector agnostic. And last but not least, we also have a partnership with Aqua for All, a strong partner in the wash space. They are the experts in water and sanitation. We are the experts in finance and incentives. So we partnered up to actually manage the impact-linked fund for wash, which has also a global scope. Here we go. I'm very happy to discuss about all these topics.
Thank you very much, Bjoern. I hope you can all hear me. I'm not sure how clear I am, but thank you very much. So please get ready with your questions. We're going to try and tackle some of the ones that I've put in the chat. But before then, Abby, do you want to put a final poll question? Ask people just kind of think through the questions. And for the questions, please just throw them, share them with them in the chat, and then we'll pick as many as we can. So the poll question: which of the following applies best to your work? Take 30 seconds to do that. So the poll question is: which of the following applies best to your work? Another 10 or so seconds. I can see so far majority of the people are working with kind of sessional high risk capital. People are working entirely with grants. Okay, cool. That kind of gives us a sense of where we're at. Bjoern, before we go into, as people putting the questions and comments into the chat, this is becoming a very interesting and growing area. Why is there suddenly such a huge interest in catalytic capital and impact in finance? Why is this attracting so much attention at the moment?
Of course, it took a long time until, and we call it our advocacy nut we have to crack, right? Because we learned, and in particular, I personally learned that the world seems to be still black and white, either purely commercial or purely giving away the money. And impact-linked finance is in between. So this comes with a lot of advocacy for hybrid forms, for blended finance, for innovative forms of deploying capital. But at the same time, it also comes with the typical skepticism, like there's another new flavor of the day. So we just had to prove that it works. And as you have seen in the statistics, in the first few years, we just did a few transactions. And then the evaluations came in, and then the results did actually prove that it works. And also the entrepreneurs that were involved were quite excited. Yeah, and then you get more and more traction. And then it becomes, hopefully, and we are still very hardly working on getting this established, it becomes just a part of the toolbox. And it's here to stay.
And there is a general perception that you lose money when you play in the impact investing space. What's your view about that? And as we know, we need to see how to get more people involved in this space. But there's a general perception that doing well and doing good are two very different things. You can't do them together. What's your perception of that?
Oh, it is a tricky one. Because when I entered this industry, I also realized that this narrative of doing good, doing well at the same time is strong. And how could you not be excited about this, right? In particular, if you come from the financing industry. But if you really want to tackle systemic challenges and really, really severe problems, then you might think differently. And there's a good reason why the whole world is flooded with subsidies in the agricultural sector, the energy sector, everywhere public subsidies to achieve an impact which is beyond just the market and beyond just what would happen if you just let the market play. I'm not against the market. As you can see, we are trying to play the market according to its roots. And for that reason, I also realized, okay, there is no shortage of market rate oriented capital, including impact investment, right? Because the narrative of doing good and doing well is a commercial narrative. So there is so much development money out there that has to be spent every single year in billions. Why not combining this and making the best deal for both sides, for society, because the donors are actually representing the public funders, society and the interests of society, and the providers of investment. And I don't want to blame anyone, because these providers of investment typically have fiduciary duties to make the return, right? And if they see an opportunity to enter in a transaction where incentives are financed by a third party, it can be a win-win for all involved.
Awesome. And Bjoern, as we've looked at how the evolution of funding development and impact has changed over time, I think one of the things that we're seeing very evidently at the moment is the decline in aid. What do you think this does, especially in the context of Africa, where we've been very dependent on aid? What do you think this does for
Okay.
We lost you.
I think we lost Frank there. And whilst is trying to connect, can I request that we move to some of the questions that were posted in the chat? I might ask a few individuals to just unmute themselves. I want to try and start at the first question that came through from Peter. Question from Peter, and Peter, you can just unmute if I get the question wrong. You're asking if they do you use SROI, or presume that's what, standard return on investment, to price the impact, or what methodologies do you use?
Oh, this is a very good question, because we actually have to price impact, which sounds a bit counterintuitive for many, right? How can you put a price tag on something which is so intangible? However, we have to do that. However, we have focused very strongly on the enterprise, and we derive everything from there. So our work involves understanding the business model of the enterprise and trying to understand how much does it cost this enterprise to generate additional impact. And of course, they should also have their margin on it. That's a business, etc. But over time, the costs get less and less, because economies of scale kick in. So to make a long story short, we are trying to benchmark pricing based on different factors in the market, like what would typically be paid, for example, to a nonprofit generating this and that impact. And of course, the price we would, the impact price we would provide to a business must be significantly lower, because a business is simply in a better position by having additional income and having synergies in doing so. And then we look at the enterprise, like what does it actually cost the enterprise, and their estimates, and how they build it in their financial models. And then we come to a price that is appropriate. And of course, at the end of the day, it's a negotiation between the enterprise and us. We are not in the carbon market, and even in the carbon market, price is heavily fluctuating. So there's no fair price for carbon, right? It's just the market price defined by supply and demand. This is different here. We are the buyer. We are representing the buyer, more or less. And so it's a negotiation. And we always, as I already mentioned, try also to find a sweet spot where the enterprise, the business anyway, wants to increase its footprint or its impact.
Thank you. And Peter, I hope you answered here. And if not, you can always either continue to chat or just unmute and come in. Lamise is asking, is impact-linked finance sector agnostic, or does it depend on how just easy it is to measure impact in certain sectors? So, for example, gender, the number of women, the number of job placements, those are sort of easier to measure, and that they're also easier to finance. Your comment on that?
Yeah, it is, of course, easier in certain sectors. And there are two criteria that needs to be in place to structure a successful impact-linked finance deal. One is also the impact has to be direct. So there needs to be a direct, causal linkage between the activity of a business and the impact. If it is really fuzzy, like many different influencing factors for a specific outcome, and you cannot attribute the result directly to a business, that's not a good idea to think of incentives, right? Or you would need to incentivize the whole system around it, but quite a complicated exercise. There are plenty of topics and sectors where you have a direct impact. Think of off-grid energy, agriculture, everything, employment, etc., etc. And the second characteristic is timing. So the impact should be created quite in a rather short term, being able actually really to monetize this in time, because you don't have anything, like you do not really benefit if there is an impact you can only achieve within 8 or 10 years. And you have to wait for any kind of cash flow out of this for such a long time, and are totally at risk during that time that you actually achieve it. And again, most of the sectors and topics I've shown you, there is typically an immediate effect. And of course, there are also interim outcomes that can be measured and that are then proxies for longer term outcomes of these business models. I hope this helps a bit. And measurement is definitely a topic which is super important. And the better an enterprise is already equipped with a proper impact measurement practice and system, the better it's prepared for impact-linked finance.
Certainly, I agree with you. I think the measurement aspect of impact work has always been a developmental area for many enterprises. And thank you for your feedback on this one. And then there's also a question that says, can you just give an example of like a seeding role, the seeding role of Catalytic Capital, an early stage sort of deal or investment that you have been involved in?
Yeah, happy to do so. So when it is about seeding, I have to say we are not financing startups like that do not yet know what their actual model will be, right? And don't have a proven business model in place. This would not be fair also, because the entrepreneurs couldn't tell us what is a realistic result they could achieve. So if businesses are still in an experimental stage, they should raise different capital. And there are several instruments out there, right? And however, if the model is kind of proven and they are now raising a relevant amount of money to scale it, like a proven model, that's the time where we can come in. That's the time where we can also make projections on the impact potential, etc. And there are so many examples of businesses we supported when they raised their Series A. So with Sync, for example, the social impact incentives, because it's a bilateral contract, we are absolutely independent from the investor. So we can provide incentives to companies that raise equity or even debt finance, because we are just having a bilateral contract and we are just interested that the company gets funding to grow. And you can also get great venture debt or revenue-based lending to grow. I'm a bit hesitant to give details because it's of course also a data question, but just to give you an idea of a typical case, a solar home system distributor working in Kenya who raises after, of course, there's no doubt about the impact of off-grid energy of solar home systems and its positive effects. A company like that raising established with an established distribution structure, raising a Series A of whatever, 500,000, 1 million, would then agree with us on a sync agreement of, let's say, when they raise $1 million, this could be kind of $250,000. This would be a traditional seed stage investment for us. Of course, there are different definitions of seed capital, but I think you got it.
Thank you. Again, seed capital. Is it post proof of concept? Is it if you traded and you're looking for scale? So I think it can be defined from so many angles. There's another question here. I think it's so direct. So how does a catalytic capital fund make their money?
Oh, they don't make money. That's actually the trick. So coming back to what I said before with the billions of development finance to be spent every year, this money doesn't seek return, right? And this money seeks impact. And our promise, and the promise of impact-linked finance, and the promise of any catalytic capital is optimizing for impact and accelerating growth and bring it on scale. And when you look at our own business model, we are a manager of capital. So we get our fees, of course, of doing this work. And that's very strongly connected to our transactions. So the work needs to be done on the transactions. We are paid by our funders to do this work. The enterprise doesn't have to pay anything. They are the ones we see as the benefiting from this. Of course, they have to engage with us. It's quite some interaction happening between us and the enterprise. But that's actually the business model of implementers like us.
Well, thank you for this one. And I would like to just come in with the sort of a spin on that question. Do you see any role for governments, considering there's no money to be made? Yeah, I mean, what's your take on governments and them getting a role in catalytic capital investment?
Well, absolutely. This is, I would say, the dream exit is that you test something, that you prove what is possible, what a little bit of subsidy, what effects can a little bit of subsidy have in terms of public good and social value created. That also translates probably in less spending by domestic governments. And over time, these governments should take over these the outcome payments, for example, in these transactions. And there are good examples, and in particular in Africa, Aseli Africa was actually inspired by the root capital transaction I showed, and now does this on scale. They are just providing incentives to agricultural lenders in certain countries in Africa. And their clear idea is, over time, we want to not, at the moment they are funded by international donors, but over time they want to get the ministries, the agricultural ministries, etc., paying these let's say incentives. It's of course a super tricky thing and a long-term play, I would say.
No, thanks for that. I think I could probably ask on how corruption would come into that, but I think for now I'm happy to move on. So I'm going to, I see, is it Megan? You've got a hand up. Do you just want to unmute yourself and ask away before I get back to the questions in the chat? Is it Megan? Am I getting it correctly? You can just unmute yourself. Oh, okay. Please just do when you can, in case it's a technical challenge. There's a question here. I think you've mentioned your involvement in East Africa. Do you have plans to move to West Africa, or are you already working in West Africa?
We do already work in West Africa with the Impact Linked Fund for Education. And
Hello?
also, hello?
Yes, we can hear you. Again, I think your network is bad, but please try. Sorry about that.
Hello? Am I audible?
I think your connection is really poor.
Apologies for that. I was having difficulties unmuting myself. So I'm someone who's visually impaired within the innovation and technology space. And am I not audible at all?
We can hear you. I think please
Hello?
continue. You can continue. I think we're getting.
Hello?
Yes, we can hear you now. All right. I think there is a bit of a challenge there. We
Okay,
just
so
allow to.
am I audible now?
Yes, you are. Please go
Okay,
ahead.
thank you so much. Apologies for that. I'm in the midst of load shedding. Okay, so my question was that in terms of equity, are there any equity goals?
I don't know if there was more to that question, but are there any equity goals? Do you? Is it an equity piece to?
Are there any equity goals that are being measured against to ensure that perhaps, for example, we've got women who then become prioritized to ensure that some of these investment agencies do prioritize in getting them investments, and also perhaps persons with disabilities, because a lot of the time we find that with investment opportunities, there is no prioritization of the disability sector. Therefore, we're not able to actually become global competitors.
I think I got the key content of the question. Let me quickly try to answer. So it was actually about focusing on disabled people and also the general question of equity in distributing funding or providing incentives. Actually, what is really important is that impact linked finance and any kind of incentives or rewards for impact needs to be, of course, filled with priorities. So we are an intermediary. We do not, unfortunately, we don't do our own agenda. So we cannot dictate how the priorities are. We can suggest, and we have very strong opinions sometimes, but we are not making policy, right? So if we get, for example, funding from one of our key partners, the Swiss government, for example, which was pioneering this practice with us and is at the forefront, then we might get funding, for example, from the global program migration. And this team has their budget, and then this budget needs to be focused on outcomes, positive outcomes for migrant people, for example. And of course, then we can suggest, yeah, but what about prioritizing migrant women? What we do, and these kind of things get specified. And that's actually the beauty, but also the challenge. So we all need to be, like the funders in particular, need to be crystal clear about the results they want to achieve. And they can decide about any kind of nuances and any kind of, target groups they want to reach. And for example, explicitly focusing on positive results for disabled people or for other marginalized groups. That's absolutely possible. That's the whole point, right, of impact-linked finance, that you can direct funding towards these underserved individuals or groups or communities, but it has to be defined upfront. And then the whole program, the incentives will follow. And we have a tool here, and you can use this tool in very different ways.
Thank you for this. I should say, when you're talking marginalized communities, I think the focus on women, I think it's less on people with disabilities. So thank you for addressing this, and thanks, Megan, for bringing this up. I'm glad we actually got to hear your question. One question I would also just want to put forward is, so when we're looking at sustainable development, catalytic or impact investment, this model seems like a no-brainer. Like, this is what Africa needs, right? Why do you think there hasn't been more adoption of this in Africa, of this model of investment in Africa? What are the main challenges? Or
first, I would like to quote you. That's a no-brainer. This is exactly what Africa needs. That's my call. But look, we also have to understand the priorities of the funders, and without calling out names, I can give you just an example. We did train a group of people working in a public environment in the government, and they were explicitly working with all types of catalytic capital. And there are different types of catalytic capital, right? And we were, of course, providing a training explicitly on impact-linked finance. And at some point, when we had this discussion, why this is a no-brainer, why don't you just do more of this, or why don't you just use it? There came a statement which was a bit shocking. And this was about their targets, their objectives, how they measure success. And they measure success in getting money out of the door, full stop, right? I need to deploy so and so much money within this year, and that's my target. And of course, I need then to frame it, hey, this was for gender, this was for this was for that. But there's no measurement attached. There's no, let's say, nuanced understanding about what to achieve with that. And the preferred tool of these people, of course, are different than impact-linked finance, because impact-linked finance requires a bit more work than a guarantee, right? With a guarantee, you can just mobilize significant amounts of money, but you do not necessarily know what the results will be. Same is true if you just provide concessional loans to specific sectors. Then you just believe in the sector, but not necessarily in the concrete outcomes that you are financing. I don't say that's wrong. I just say the objectives and incentives on the level of the funders do absolutely make a difference.
there is a question that says, what was your personal reason for starting this venture?
Oh,
I think it speaks to what you're saying now.
yeah, but there is another, let's say, very important point to make, because when I came from the finance industry, I was, of course, like many others, totally excited about the opportunities in impact finance more in general, right? Impact investing. However, I learned that it's not as easy as it sounds, and that it needs really a much better understanding about the needs of the entrepreneurs. That's one thing. And also it needs a better technical practice to really achieve impact. And I found the system a bit flawed in that respect. And that is actually the reason why I was super excited at some point to see that blended finance as a concept could actually solve a lot of problems that I saw were not addressed so far, because it actually really, you can structure it in a way that it really fixes market failures and gaps. And however, then I realized, oh, blended finance is at the end also just getting money off the door, mainly, right? And impacting finance is an answer to, hey, you can do blended finance in a way that is super targeted. It's like drip irrigation, right? Instead of just flooding the field, it's dripping. Like here you need something and here you need something. And that's my personal, now my personal mission is making this practice available, accessible, and establish it. And we are even concretely working on field building activities, also to help others to do this.
Thank you. I think in the interest of time, I would want you to give some closing remarks. However, whilst I still have a couple of people's attention, I want to highlight what's the sort of the lead up, what this webinar is leading up to. So this is the second of a 3-part sensitization webinar series around catalytic capital investment, and AVPA will be running a catalytic capital investment training program, which starts in Q2 of this year. So if you're interested in this, please let us know, and we'll also just be, check our socials, and people on this call will be sending you messages on the training. Let me take some closing remarks from yourself.
Sure. I just want to thank you for giving me the opportunity again. I was stepping in from Natasha, my wonderful colleague who is sick. Greetings from here. Maybe at some point she will also watch the recording. Get well soon, Natasha. And thanks to your members, your community, AVPA, and also C3 for making this possible. I think catalytic capital is the answer to many of the challenges Africa and the world is facing. Thanks a lot.
Thank you. Really appreciate. I'm super excited. Apart from being an AVP member myself, I'm looking forward to this training because I called it a no-brainer, but I actually think it is a solution to most of the challenges we're facing as Africans and in Africa. Please just look up the chats, email us any other questions you might have. Someone has asked for, are we going to share the slides? We will consult and share if possible. Otherwise, we'll always share, the main points coming out of the discussion as well as the recording. I want to thank you all for attending. Look forward to our invites to the March webinar, which I believe will just be as insightful and most importantly, please sign up for the training if you find this to be a space we should be in. Thank you all. I will call this webinar to an end.